In August 2007, as the world stood on the edge of the great financial crisis, I started my career at UBS Investment Bank on Wall Street.
Nearly $700 billion in losses for government pension funds.
The worst day on Wall Street since the crash of 1987.
The collapse of Lehman Brothers triggered turmoil in markets around the globe.
Just a few weeks into my new job, as I sat here on the biggest trading floor in the world, UBS announced it was firing thousands of people. As a fresh college graduate from a poor European family where nobody knew anything about stocks or bonds or investing, I felt completely lost during this crisis. But over the next few years, I got an amazing investment education. Fast forward 17 years and I've invested hundreds of millions of euros for my clients. I co-founded an investment company here in Europe which serves over 150,000 clients, and my own investment portfolio has reached 7 figures, mostly investing in ETFs. In this video, I want to share the most expensive investment mistakes that I made over the past 17 years and the most valuable lessons that I've learned, lessons that could help you make more money and avoid losses on your own investment journey. The first mistake I want to look at is by far the most expensive. If you can avoid this one, it can literally double or triple your wealth when you retire. Now, to understand this mistake, we have to go back in time. Have you ever daydreamed what it would be like if you could go back to the year 2000 and buy some Amazon shares?
Well, we are a famously unprofitable company.
Well, I daydream about buying the S&P 500 back in March 2009. And the painful thing is, I was so very close to doing it. In March 2009, it was the depths of the financial crisis. The newspapers were full of scary headlines. The S&P 500 had fallen by something like 50% from the peak. From today's perspective, that means stocks were super cheap. It was an amazing time to start investing and buy a share of the global economy. But when the crisis started and my bank was firing people, I got scared. Now, some of my colleagues, they said, like a crisis like this, it's an opportunity, just start investing. But others said the exact opposite. I remember talking to Jim. He was an experienced trader on the distressed credit desk, so he had a lot of experience dealing with companies and governments in financial trouble. He said, well, listen, pal, if a few more things break, the whole US financial system is going to collapse. We're going to have a depression for 15 years. And that scared me, obviously. So I didn't start investing in 2009. I also didn't start in 2010 or 2011 when the market went up because I was still kind of scared. By then, I had moved back to Europe. I was in my 20s, enjoying life, dancing salsa, thinking about girls, and for the next few years, investing was not a big priority for me. I only came back to investing in a big way in 2016 when my wife got pregnant, because that scared me much more than the market ever did. I wasn't ready financially to take care of my family. So I finally decided, okay, I need to save and invest. And the sad thing is, I had to jump in and buy the market when the S&P 500 was 3 times higher than back in 2009. Stocks were much more expensive. It was still the right choice. Starting investing is how I put my family on the path to financial freedom. Today, we are much better off because I did finally start. But if I'd started back in 2009, I would be so much richer. It's not even funny. The sad thing is, I have 17 years of professional investment experience, but only 8 or 9 years of real personal experience. And that has really hurt my finances. So if there's one thing I want you to take away from this, there's never a perfect time to start investing. It is always a bit scary, and it is so easy to delay and let it slip for months and years. Trust me, I'm not just saying this. I know. If you keep delaying and then you look back 10 years from now, well, it's going to be painful. It's such a big missed opportunity. So just start investing now and don't wait for the perfect time. Now, of course, once I started investing, that was not the end of the mistakes that I made, not even close. This next mistake is a real wealth killer. Back around 2017, when I decided to really invest my money, I said, okay, I want a diversified global ETF with low fees. After a few iterations, I ended up with IUSQ. So this is the iShares MSCI All Country World Index UCITS ETF. It's a fund that invests in global stocks. Now, if we go to the fund website and look it up, and we click on performance, and we look at the fund results, you will see that between 2017, when I got started in a serious way, and today, The average return for this fund has been around 11% per year. But did I earn 11% per year on my money? Well, it's tricky to calculate the exact numbers, but I probably grew my savings at around 8 or 9% per year instead. And here's the reason. I always had a really big safety cushion sitting uninvested. Now, of course, having a safety cushion is a good idea. You need to keep enough money in the bank to cover expenses for a few months if you lose your job or something bad happens. But in my situation, where I had a well-paid job and strong unemployment protections, I should have been fine with maybe 3 to 6 months of expenses in the bank. But in fact, I often had a lot more cash than that just sitting there. That was just a psychological coping mechanism, a way of dealing with the risk of investing in the market. And the result was that my wealth grew much slower than it would have otherwise. So the second mistake that a lot of people make is underinvesting. So if you decide to buy ETFs, but you only put 60% of your savings into ETFs and the rest just sits in the bank, well, you're not going to make nearly as much as you could. Okay, so these are the two really painful mistakes that I made in my investments: delaying too long and underinvesting. And do I regret them? Of course, they hurt my finances a lot. But I've also done a lot of things right. So I want to share a few of those lessons as well. The first lesson, well, I only mastered it when investing millions of euros for my clients. So back in 2017, we launched a new pension fund in Latvia called Indexo. We were the first to bring ETF and index investing to our country. We promised our clients we would do 100% passive investing. So here's what that means. Active investing is when you come in and try to guess which are the best stocks to buy. When do you buy? When do you sell? You definitely try to time the market and get the best possible result. Passive investing, by contrast, simply invests in the whole market. So that's usually index funds and ETFs. You buy a little bit of every stock in the market and you keep buying every month without paying attention to news headlines. There's a lot of evidence out there that passive investing works better than active investing. So with Indexo, that's what we brought to our market. Now, to me personally, this was kind of a terrifying experience. For the first time in my life, I was responsible for hundreds of millions of euros invested by tens of thousands of regular people for their pensions. Okay, they could not afford to lose this money. So when I read articles about how the market was going to crash, it did kind of freak me out, even though I knew it wasn't rational. And then our competitors would publicly say that our approach was idiotic, that we were sure to lose our clients' money because they, the competition, they could time the market and avoid market drops, while we just had to be passive. Even though I knew that was nonsense, deep inside I had this fear. What if they're right? But of course, we had a system, we had made a promise to our investors, so we had to stick to it, and that's what we did. And because that's how I invested my clients' money, that's also how I invested my own money. I invested passively because I didn't want to be a hypocrite. Now, what happened? So this is a graph of all the pension funds in our country, in our category. This is Indexo, our fund. And as you can see, our fund has been number one all the way since day one. All those competitors, they fell behind. We proved it again. Time in the market beats timing the market. When you see a lot of stressful headlines in the news, just ignore it, stick to your system, and over the long term, you will almost certainly do great. Now, the next lesson I want to share is even more dangerous because it stops many people in Europe from investing in the first place. In 2011, I moved from America back to Europe and I got a few gigs consulting for some companies. And the companies paid me and they paid income tax and I thought everything's great. But then a year later, I got an angry letter from the government. It turns out I hadn't been paying my social security taxes. Because I had only worked in America before, I didn't know how the tax system worked in Latvia. And this was an expensive lesson for me. Whenever you want to make money in some new way, you have to figure out how taxes will work ahead of time. And I see many European investors fall down with this. Many people start buying stocks or ETFs, and then a few years later they ask me, well, Tom, should I be paying some kind of taxes on these investments? That is a bad position to be in, because you are at a high risk of getting an angry letter from your government. You should figure out how investment taxes work before you start investing. I've actually spent many months and tens of thousands of euros researching investment taxes in 34 European countries. And the good news is, in most countries, When you understand taxes, you can actually find ways to pay less legally and ethically. And it also makes your life easier because you can simplify the tax reporting and payment process. But if you just jump in and ignore your obligations, that's an easy way to get into trouble. If you're interested in this topic, make sure to hit subscribe because I cover investment taxes in Europe a lot in my channel. For example, in most European countries, you can get better tax results if you buy accumulating ETFs. But this is not true in the UK, Switzerland, Austria, or Denmark. So you really have to pay attention to local details. Okay, and there's one final lesson that I think a lot of people who watch YouTube videos about investing need to hear. A lot of my personal net worth actually comes down to just a few years at the start of my investment journey. So when my wife got pregnant 8 or 9 years ago, we decided, okay, let's start saving and investing. We lived in a cheap apartment, drove an old car. I worked really, really hard to have a good income, and we saved and invested a huge chunk of that income. And that allowed us to build wealth really, really quickly. Now, I love going on justetf.com and looking at different ETFs and trying to figure out what is the best strategy. Is it investing in the whole market? Is it small cap stocks? Is it value stocks? Is it something else? But the truth is, the single biggest factor for your investment success is not the strategy. It is your savings rate. The more money you can put aside and invest, the bigger a difference it will make in your life. So sure, spend some time learning how to invest and picking some good ETFs, but the main priority you should have is figuring out how to make more money and save more money. That is what's really going to make a difference over the long term. Now, to be sure, I've made some mistakes with my own investments, but from the moment I started investing seriously to the point where I reached financial freedom and could afford to retire early, it took me only 7 years. So if you're interested in how that happened and how that is possible here in Europe, check out this video where I explain how to retire early if you live in Europe.